Hello everyone, and welcome back to the channel. Today, we're diving deep into a question that's on every investor's mind. Is liquidity really back in the markets? We've seen some encouraging signs lately, a real shift from the tighter conditions we experienced over the past year or so. But what does this mean for you, for your portfolio, and for the economy as a whole? Are we truly seeing a revival of market confidence? Or is this just a temporary blip on the radar? Let's start by defining what we mean by liquidity. In simple terms, it's the ease with which assets can be bought and sold without causing a major swing in their price. Think of it like water in a plumbing system. When there's plenty of water, it flows smoothly. When it's low, the pipes get clogged. In financial markets, water is money, and when it's abundant, trading is easy, asset prices are stable or rising, and investors feel confident. When it dries up, trading becomes difficult. Volatility spikes and fear takes over. So, where is this new liquidity coming from? A big part of the story revolves around central banks, particularly the Federal Reserve in the US. After a period of aggressive interest rate hikes to combat inflation, we're now hearing a different tune. The market is pricing in the possibility of rate cuts later this year. This expectation alone is a powerful force. When investors anticipate that borrowing costs will go down, they're more willing to take on risk. They start moving money from safe havens like cash into stocks, corporate bonds, and other assets, effectively injecting liquidity back into the system. We can see evidence of this shift in several key indicators. Look at the bond markets, for example. Yields on government bonds, which move opposite to prices, have come down from their recent peaks. This suggests that money is flowing back into bonds, pushing prices up. We're also seeing a narrowing of credit spreads. That's the difference in yield between risky corporate bonds and safer government bonds. A narrower spread means investors are demanding less of a premium to hold riskier debt, which is a classic sign of returning confidence and liquidity. Then there's the stock market. We've witnessed some impressive rallies, especially in certain sectors like technology. This isn't just retail investors jumping on the bandwagon. We're seeing institutional money flowing back in. Major stock indexes breaking through previous resistance levels is a technical signal that many traders see as confirmation of a bullish trend, fueled by this renewed liquidity. IPO activity, which had been dormant, is also starting to show signs of life. Companies are more willing to go public when they believe there's enough investor appetite, another clear indicator of market health. But here's where we need to be cautious and ask the tough questions. Is this liquidity sustainable? Or are we just riding a wave of optimism that could crash? One major factor to consider is inflation. Central banks have signaled a pivot because inflation has been trending down. But what if it proves to be sticky? What if geopolitical events or supply chain disruptions cause another price spike? If that happens, central banks might have to reverse course, pulling the rug out from under the market. The higher for longer narrative for interest rates could easily make a comeback, and the liquidity we're seeing now could evaporate just as quickly as it appeared. Another angle to consider is the source of the liquidity itself. Some of it is coming from the Fed's balance sheet adjustments and reverse repo facility operations, which can be technical but essentially mean more cash is available to the banking system. However, is this liquidity flowing evenly across the entire market, or is it concentrated in a few large-cap tech stocks, the so-called Magnificent Seven? If it's the latter, then we're not looking at a broad-based market recovery, but rather a very narrow one. A healthy market has widespread participation. If only a handful of stocks are driving the rally, it creates a fragile foundation. The moment those leaders falter, the entire market could follow. Let's also talk about the real economy. Is the optimism in financial markets reflected on Main Street? We're still seeing mixed signals. While the job market has been resilient, there are concerns about consumer spending, which is a huge driver of economic growth. People are still feeling the pinch from the inflation we've already had. Credit card debt is at an all-time high. If the consumer starts to pull back, corporate earnings will suffer, and that's something that even abundant liquidity can't ignore forever. A disconnect between Wall Street's performance and the real economy's health is a warning sign that can't be overlooked. So, how should an investor navigate this complex environment? It's not about making a single all-in or all-out bet. It's about being strategic. First, diversification remains your best friend. Don't chase the handful of stocks that are making headlines. Ensure your portfolio is spread across different sectors, geographies, and asset classes. If the tech-led rally fizzles, you want to have exposure to other areas like healthcare, consumer staples, or industrial stocks that might perform differently. Second, focus on quality. In times of uncertainty, companies with strong balance sheets, consistent cash flow, and a durable competitive advantage, what Warren Buffett calls a moat, tend to hold up best. These are the businesses that can weather economic downturns and don't rely on cheap money to survive and thrive. They are less vulnerable to the whims of central bank policy. Third, consider your time horizon. Are you investing for next month or for the next 10 years? Short-term market movements, driven by liquidity flows and sentiment, are notoriously hard to predict. But over the long term, fundamentals like earnings growth and innovation are what truly drive returns. If you have a long time horizon, you can afford to ride out the volatility. Don't let the daily news cycle panic you into making rash decisions. It's also crucial to stay informed, but not overwhelmed. Pay attention to the big picture data, inflation reports like the CPI and PCE, jobs numbers, and, of course, the statements from the Federal Reserve. Understand what they mean, but don't obsess over every tick of the market. Develop a solid investment plan based on your personal financial goals and risk tolerance, and stick to it. In conclusion, yes, we are seeing a significant return of liquidity to the markets, and it's reviving confidence. The prospect of lower interest rates has been a powerful catalyst. However, the situation is fragile. The recovery is not yet broad-based, and risks related to sticky inflation and a potential economic slowdown remain very real. The key is to approach the market with a sense of cautious optimism. Acknowledge the positive momentum, but don't get carried away. Stay diversified, focus on quality, and keep your long-term goals in sight. The path ahead is likely to have more twists and turns. So let's define our terms. When we talk about liquidity, what are we actually talking about? In the simplest sense, it's the ease with which you can buy or sell an asset without causing a major price swing. Think of it like water in a system. When there's plenty of it, everything flows smoothly. But when it dries up, things get sticky and transactions become difficult and expensive. In the financial markets, this water is money, cash ready to be deployed. High liquidity means lots of buyers and sellers, tight bid-ask spreads, and the ability to move large positions without rocking the boat. So when we ask if liquidity is back, we're really asking a few things. Are central banks easing up on their tight monetary policies? Are institutional investors feeling confident enough to put their massive cash reserves back to work? And are retail investors like you and me feeling secure enough to jump back in? It's a complex picture. Now, let's talk about what real healthy liquidity looks like. It's not just about stock prices going up. A true liquidity-driven rally is characterized by several key features. The first is high trading volume. I'm not just talking about a one-day spike driven by a meme stock. I mean sustained, broad-based volume across the entire market, from blue-chip giants to small-cap contenders. This shows that there's genuine conviction and participation, not just a few big players making waves. When you see volume charts ticking up consistently across various sectors, that's a very positive sign. It tells you that the recovery isn't just concentrated in one or two hot areas, but is lifting the whole market. The second sign of real liquidity is a narrowing of bid-ask spreads. The spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. When liquidity is low, this spread widens. It's riskier for market makers to hold inventory, so they build in a bigger buffer. But when liquidity returns, competition heats up. More buyers and sellers mean market makers can tighten those spreads because it's easier to offload their positions. So if you're seeing those spreads get razor thin on the assets you're watching, it's a strong indicator that the plumbing of the market is working well again. Third, and this is a big one, is the return of the IPO market. When companies feel confident that they can raise capital successfully, they start going public. A healthy IPO market is like a vote of confidence from both the companies themselves and the investors who buy their shares. It shows there's an appetite for new ideas and a willingness to invest in future growth. When you start seeing a steady stream of quality companies listing on the stock exchange and their IPOs are well received, it's a powerful signal that risk appetite and, by extension, liquidity are back in a meaningful way. It means the system has enough cash to not only support existing assets, but also to fund new enterprises. Another crucial element is the behavior of institutional investors. These are the pension funds, the insurance companies, the endowments, the real heavyweights. They tend to manage enormous pools of capital and are typically more conservative. When they start deploying cash from the sidelines back into equities and other risk assets, it's a massive injection of liquidity into the system. You can often see this in fund flow data. Are mutual funds and ETFs seeing net inflows? Are institutional asset managers reporting that they're reducing their cash positions? When this wall of money starts to move, it creates a very powerful and sustainable tailwind for the market. We also have to look at the credit markets. How easy is it for companies to borrow money? When liquidity is abundant, credit spreads, the extra yield companies have to pay over government bonds to borrow, tend to tighten. This means investors are demanding less compensation for taking on credit risk, a sign of confidence. It's cheaper and easier for businesses to fund their operations and invest in growth, which is good for the economy and ultimately for the stock market. So keep an eye on corporate bond yields and credit default swap levels. A healthy credit market is a prerequisite for a healthy equity market. Now, let's distinguish this from a fake-out rally. Sometimes a market can pop on low volume. This is often driven by short covering, where bearish investors are forced to buy back shares to close out their positions, artificially driving up the price. These rallies tend to be sharp but short-lived, and they often fizzle out as soon as the short covering pressure subsides. They lack the broad participation and sustained volume that characterize a genuine recovery. The rally might also be concentrated in just a handful of big-name tech stocks, while the rest of the market languishes. This isn't a sign of broad liquidity. It's a sign of a flight to perceived safety within equities. So, what should we be looking for right now? We've seen some central banks pause their rate hikes, which is a necessary first step. This stops the draining of liquidity from the system. But what we really need to see is a pivot towards easing. We need to monitor trading volumes across different market caps and sectors. Don't just look at the S&P 500, see what the Russell 2000 is doing. Small caps are often more sensitive to domestic economic conditions and liquidity. Watch the IPO calendar. Are interesting companies testing the waters? And pay attention to fund flows and institutional cash levels. Are the big players putting their money where their mouth is? In conclusion, identifying the return of real liquidity requires looking beyond just the daily price movements of major indices. It's about seeing the whole picture. Sustained high volume, tight bid-ask spreads, a revived IPO market, institutional money flowing in, and healthy credit conditions. It's the difference between a shallow puddle after a brief shower and a deep flowing river that can carry the market forward for the long term. By understanding what real liquidity looks like, you can better position yourself to navigate the markets and avoid getting caught in a deceptive rally. It's about being a detective, piecing together the clues to understand the true health of the market. Thanks for tuning in today. I hope this breakdown gives you a clearer framework for analyzing the market's current state. It's a fascinating time, and staying informed is your best tool. If you found this helpful, please hit that like button and consider subscribing for more deep dives into the world of finance. Drop your thoughts in the comments below. Is liquidity back in your view? I'd love to hear your perspective. See you in the next video.